You know, I've been investing for over 7 decades now, and I've seen a lot of things that made people panic. I've seen wars, recessions, inflation spikes, and market crashes. But what we're witnessing right now with President Trump's tariff regime is something I haven't seen since I was a young man reading about the Smoot-Hawley Tariff Act of 1930 in my history books. Let me be direct with you. We're living through the highest tariff rates America has imposed since 1941. That's not hyperbole, that's fact. The average U.S. tariff rate has jumped from a comfortable 2.5% in early 2025 to an eye-watering 27% after what Trump called Liberation Day on April 2nd. We're talking about effective tariff rates of 145% on Chinese goods, 46% on Vietnamese products, and baseline rates of 10% on virtually everything else coming into this country. Now, I want you to understand something crucial. Tariffs aren't paid by foreign countries, no matter what anyone tells you. They're paid by American companies and ultimately by American consumers, by you. This is a tax increase, plain and simple. The Tax Foundation estimates this amounts to nearly $1,300 per U.S. household in 2025. This is serious business, and I'm going to walk you through exactly what's happening, what it means for your investments, and how you should be thinking about protecting your wealth in this environment. Let me tell you a story from my early days. In 1930, Congress passed the Smoot-Hawley Tariff Act, raising tariffs on over 20,000 imported goods. Economists warned it would be disastrous. They were right. World trade collapsed by about 65% between 1929 and 1934. And many historians believe it turned a recession into the Great Depression. Now, I'm not saying we're headed for another Great Depression, but I am saying that history doesn't repeat itself. It rhymes. And what I'm hearing right now sounds awfully familiar. The numbers don't lie. When Trump took office on January 20th, 2025, he immediately directed his administration to prepare comprehensive tariff plans. By April 2nd, Liberation Day, as he called it, the floodgates opened. Here's what we're dealing with. The weighted average applied tariff rate on all imports rose to 18.2%. with the effective rate at 13.1% when you account for behavioral changes in purchasing patterns. This represents the largest U.S. tax increase as a percentage of GDP, 0.54%, since 1993. That's bigger than the tax increases under Obama, bigger than anything under Bush. China faces the most punitive rates, 145% cumulative tariffs after rounds of escalation and retaliation. Vietnam, where Nike makes half its shoes and where many companies fled after Trump's first trade war, now faces 46% tariffs. Indonesia, 32%. Cambodia, 49%. Even our neighbors aren't spared. Canada saw 35% tariffs. Mexico faced 25% before negotiations. The market's violent reaction. On April 2nd and 3rd, the stock market did something it rarely does. It panicked. The S&P 500 lost nearly 12% in less than a week. That's $3 trillion in shareholder value evaporating into thin air. The 30-year Treasury bond rate made its biggest jump since 1982. I watched stocks I've owned for decades get absolutely hammered. Nike fell 14% in a single day. $14 billion in market value gone. Apple, despite Tim Cook's best efforts to play nice with Trump, saw massive volatility. Under Armour plunged 20%. These aren't speculative tech startups. These are America's most established companies. The U.S. Economic Policy Uncertainty Index, which measures exactly what it sounds like, jumped to a top percentile reading relative to the last 40 years. Goldman Sachs research estimates that if these tariffs are sustained, S&P 500 earnings per share could be cut by 2 to 3%. Their models suggest the fair value of the S&P 500 could decline 5% in the near term. But here's where it gets interesting. After that initial panic, Trump blinked. He announced a 90-day pause on the most severe tariffs. The market rallied. Since its early April low, the S&P 500 has gained an astonishing 26%. Why? Because investors developed a theory called the TACO trade. Trump always chickens out. And you know what? So far, they've been right more often than they've been wrong. Trump threatens massive tariffs, markets tank, then he negotiates and lowers them. Japan went from a threatened 25% tariff to 15%. South Korea got 15%. Vietnam, Philippines, and others negotiated their rates down to 19 to 20% during the 90-day pause. The market essentially started treating Trump's opening positions as just that, opening negotiation positions, not final policy, the real cost. But here's what worries me. Even with the negotiations and the pauses, we're still dealing with tariff rates dramatically higher than anything we've seen in modern times. The baseline 10% tariff on everything, that stays. The escalating tariffs on China, still climbing. Section 232 tariffs on steel, aluminum, and copper at 50%, those are real. U.S. tariff revenue has exceeded $30 billion per month in late 2025, compared to under $10 billion per month in 2024. That's not free money. That's coming straight out of the pockets of American businesses and ultimately American consumers. When Nike's CFO announced that tariffs would add approximately $1 billion to their costs, that wasn't theoretical. Walmart, Target, Best Buy, Home Depot, they've all announced or considered price increases. In May and June, multiple retailers warned that price hikes were coming for back-to-school shopping season. The Footwear Distributors and Retailers of America sent a letter to Trump signed by 76 brands, including Nike, Adidas, Skechers, and Under Armour, calling the tariffs an existential threat to the industry. They warned that companies will face cumulative tariffs of 150% to 220% on footwear. Now let's talk about what this means for specific companies, because this is where theory meets reality, where policy meets your portfolio. The retail massacre. Charlie Munger, my late partner, used to say, "Show me the incentive and I'll show you the outcome." Well, the incentive structure here is clear. If you manufacture overseas, you're going to pay through the nose. Take Nike. This is a company I've watched for decades, not in Berkshire's portfolio, but one I respect. Nike spent the last decade moving production out of China to avoid Trump's first round of tariffs. Smart move, right? They went to Vietnam, Cambodia, Indonesia. Now Vietnam faces 46% tariffs, Cambodia 49%, Indonesia 32%. Nike makes 28% of its goods in Vietnam, 16% in China, 15% in Cambodia. They got hit from every angle. When the tariffs hit, Nike's stock dropped 14% in one day. $14 billion gone. Their CFO had to announce they'd be evaluating corporate cost reductions and raising prices. In June, they announced price increases, effective June 1st. The running shoes that were $120, they're going to be more. But here's the thing. Nike's competitors are in the same boat. Adidas, Puma, On Running, they all manufacture in the same countries. So Nike might not lose market share domestically, but the entire category gets more expensive. The consumer loses. Apple is perhaps the most fascinating case. Tim Cook has been playing a delicate dance with Trump. In February, Apple announced a $500 billion investment in the U.S. over 4 years. Trump loved it, praised Cook publicly. But when Cook later said Apple would shift iPhone production from China to India rather than to America, Trump went ballistic on Truth Social. I have long ago informed Tim Cook of Apple that I expect their iPhones that will be sold in the United States of America will be manufactured and built in the United States, not India. Trump posted threatening at least a 25% tariff on iPhones. Here's the economic reality. Apple can't just flip a switch and manufacture iPhones in Nebraska. The supply chain is incredibly complex. It took decades to build in China. Apple sources components from Japan, South Korea, Taiwan, Vietnam. Substantially all of its production happens in Asia. A truly American-made iPhone would cost dramatically more, probably double the current price, and take years to set up. So Apple is stuck. They're trying to move production to Vietnam and India to reduce China exposure. But now both those countries face significant tariffs. India at 27%, Vietnam at 46%. No matter where they go, they're hit. Target and Walmart, America's biggest retailers, are in similar binds. Target gets 30% of its goods from China. They had a terrible first quarter, partly due to boycotts, partly due to tariff fears. Walmart, ever the master of low-cost operations, announced its customers will see higher price tags. When Walmart, a company that's built its entire business model on everyday low prices, tells you prices are going up, you better believe it. Best Buy faces perhaps the most acute pain. They get 55% of their products from China and 20% from Mexico. Consumer electronics, TVs, computers, smartphones, are heavily dependent on rare earth elements, predominantly processed in China, as their SEC filing notes. They can't easily swap suppliers without massive disruption and delay. The auto industry's perfect storm. Then there are the automakers. Trump imposed a 25% tariff on automobiles in April. Not a single 2025 model year vehicle sold in the U.S. gets more than 80% of its content from the U.S. Not one. Cars are incredibly complex products, with supply chains spanning multiple countries. Your American car might have a transmission from Mexico, chips from Taiwan, steel from Canada, and assembly in Alabama. These tariffs don't care about that complexity. Volkswagen is exploring adding an import fee to U.S.-bound vehicles. Mercedes-Benz and Volvo are looking at boosting U.S. production, but that takes years and billions in investment. You make that investment when tariff policy could change with a single presidential tweet. Tech's trillion-dollar headache. The tech sector has been particularly volatile. Despite everything, NVIDIA has actually performed well, up 47% since Trump's tariffs began, as Trump himself touted. But that's misleading. NVIDIA and AMD rushed to ship next-generation graphics cards to U.S. warehouses before tariffs hit, essentially front-running the policy. That's not sustainable. Trump is now threatening a 100% tariff on semiconductor imports. If that happens, the economics of the entire tech industry change overnight. NVIDIA's Jensen Huang claims the impact of tariffs won't be meaningful to them, but then announced hundreds of billions in domestic manufacturing investment with TSMC in Arizona. Actions speak louder than words. The furniture fiasco. In September and October, Trump announced yet another wave of tariffs. 50% on kitchen cabinets and bathroom vanities, 30% on upholstered furniture, 25% on heavy trucks, 10% on lumber and softwood timber. Home builders warned this would deter investments in new homes and renovations at a time when housing affordability is already at historic lows. Canada, America's largest wood supplier, already faces over 35% in duties. Adding 10% more on lumber is like throwing gasoline on a fire. The Supreme Court wild card. Now here's something crucial that most people aren't paying enough attention to. Multiple federal courts have ruled that Trump exceeded his authority in imposing these tariffs under the International Emergency Economic Powers Act, IEEPA. The Court of International Trade and the Court of Appeals for the Federal Circuit both said Trump's use of IEEPA for tariffs is illegal, that Congress never delegated that authority to the president. The Supreme Court is hearing oral arguments on November 5th, 2025. If the Supreme Court rules against Trump, these tariffs could be struck down. But Treasury Secretary Scott Bessent has already hinted the administration has backup plans. Section 122 of the Trade Act of 1974, which allows broad 15% tariffs for 150 days. One way or another, Trump seems determined to keep tariffs in place. This uncertainty, not knowing if the legal foundation of these tariffs will hold, is itself damaging to business planning and investment. You know, it's funny, when I first started in this business, one of the early lessons I learned was that the obvious effects of a policy are usually just the beginning. It's the second and third order effects that really matter. Let me walk you through what most people aren't seeing. The inflation time bomb. Everybody's talking about whether these tariffs will cause inflation. Let me be clear. Tariffs are inflation. They're a tax on imported goods that raises prices. It's not a question of whether, it's a question of how much and how fast. The University of Michigan's Consumer Sentiment Index fell to 57.9 in March 2025, a two-year low. Inflation expectations for the year ahead jumped to 4.9%. People aren't stupid. They can see this coming. But here's the sneaky part. It's not just the imported goods that get more expensive. When Nike shoes cost more due to tariffs, New Balance can raise their prices too, even if their shoes are made in America. Why? Because they can. That's called pricing power, and tariffs hand it to domestic competitors on a silver platter. When lumber gets hit with a 10% tariff, and domestic lumber suppliers face less competition, they raise prices too. Suddenly your kitchen renovation costs 15% more, and only a fraction of that increase actually went to tariff revenue. The rest is just higher profits for companies that now face less competitive pressure. Goldman Sachs economists estimate the effective tariff rate will eventually reach 17% once all announced policies are implemented. Every percentage point increase in tariffs typically translates to a 0.1 to 0.2 percentage point increase in core inflation. We're talking about meaningful inflationary pressure at a time when the Federal Reserve is trying to keep inflation under control. The supply chain nightmare. Here's something that doesn't show up in the stock market immediately, but matters enormously: supply chain disruption. When Trump announced these tariffs, companies engaged in what's called inventory front-running. They rushed to import goods before tariffs hit. That's why the aggregate S&P 500 inventory to sales ratio was unchanged in the first quarter of 2025, despite tariff fears. Companies were stockpiling. But that inventory doesn't last forever. By summer 2025, major retailers were warning that inventories would run low. The footwear distributors warned that under the tariff scheme, shoe inventories would soon run low and couldn't be replenished at affordable prices. Building new supply chains takes time, years, not months. If you're Nike and you want to move production from Vietnam to, say, India or Africa, you need to find manufacturers with adequate capacity, transfer technical specifications and quality standards, train workers, test and validate product quality, set up logistics and shipping routes, establish quality control processes. This takes 2 to 5 years minimum for a company of Nike's scale. You can't just flip a switch. Meanwhile, you're paying those tariffs every month. The investment desert. Charlie Munger used to say, the big money is not in the buying and selling, but in the waiting. But businesses can't wait when policy is this uncertain. Capital expenditure plans across American industry show wide variance. Some sectors, especially AI-related infrastructure like utilities and data centers, are seeing spending increase. But traditional manufacturing, spending plans are being shelved. Why would you invest billions to build a new factory when tariff policy could completely change in 6 months? When the Supreme Court might invalidate the entire tariff structure? When Trump might tweet tomorrow that he's raising tariffs another 25%? This uncertainty creates what economists call a wait-and-see environment. Companies postpone investments, hire fewer workers, and focus on preserving cash. That slows economic growth. J.P. Morgan raised the probability of a U.S. recession to 60%. S&P Global put it at 30 to 35%. Those are not insignificant odds. J.P. Morgan's head of economic research titled his note, "There will be blood." Not exactly subtle. The dollar's dilemma. Here's an interesting twist that most people miss. Trump's advisors, particularly Stephen Moran, have a theory that tariffs can be used to weaken the dollar. The idea is that the dollar is overvalued because of its reserve currency status, and tariffs could bring it down. A weaker dollar makes American exports more competitive, which sounds great. But it also makes imports more expensive, which is inflationary. And if the dollar loses reserve currency status, America loses enormous financial advantages we've enjoyed for 80 years. This is playing with fire. The dollar's reserve status gives America the exorbitant privilege of borrowing cheaply and running deficits without immediate consequences. Undermining that for short-term trade gains would be, in my view, monumentally foolish. The retaliation cycle. Let's not forget, other countries don't just sit there and take it. Canada imposed retaliatory tariffs of 30 billion Canadian dollars on U.S. goods. China escalated to 125% tariffs on American products before the temporary truce. Europe threatened major retaliations. During Trump's first-term trade war in 2018-2019, studies found that retaliatory tariffs had clear negative employment impacts, particularly in agriculture. American farmers got crushed. The government ended up having to pay billions in subsidies to keep farmers afloat. This time could be worse. We're talking about a much broader, more aggressive tariff regime. If every major trading partner retaliates proportionally, American exporters, farmers, manufacturers, service providers, will see their foreign markets shrink dramatically. The Tax Foundation estimates that incorporating the negative effects of retaliatory tariffs reduces projected tariff revenue by $146 billion over a decade. That's on top of the $411 billion reduction from the domestic economic damage. The consumer squeeze. Let's bring this down to Main Street. Lower income consumers are facing the worst of this. Housing costs already consume nearly half their disposable income. Now add higher prices on clothing, Nike, Gap, Lululemon, Abercrombie. Higher prices on electronics, Apple, Best Buy. Higher prices on furniture, 50% tariff on cabinets and vanities. Higher prices on toys, Mattel facing 100% tariffs. Higher prices on household goods, Target, Walmart passing through costs. Higher prices on vehicles, 25% auto tariff. The Tax Foundation calculates this as $1,300 per household on average. But that's just the direct effect. Factor in the secondary price increases from reduced competition, and you're looking at $1,600 in 2026. For a family making $50,000 a year, that's a 3% reduction in purchasing power. For a family making $150,000, it's 1%. The burden falls hardest on those least able to bear it. The currency of uncertainty. I want to emphasize something that doesn't get enough attention. Uncertainty itself is a cost. Markets can handle bad news. They struggle with not knowing what the news will be. Right now, every CFO in America is trying to plan for a future they can't predict. Will tariffs go up or down? Will the Supreme Court strike them down? Will Trump negotiate them away? Will Congress act? That uncertainty shows up in risk premiums. Goldman Sachs estimates that the recent spike in the Economic Policy Uncertainty Index could increase the equity risk premium, the extra return investors demand for holding stocks, by about 3%. That means lower stock valuations, all else equal. For a company considering a 10-year investment, uncertainty about trade policy is paralyzing. The value of long-term investments depends on being able to project future cash flows. When policy can change overnight via presidential decree, those projections become guesswork. The winners. Yes, there are some. Now, it's not all doom and gloom. Some companies and sectors benefit. Domestic steel producers like Nucor and Steel Dynamics love 50% tariffs on steel imports. Their pricing power just went way up. U.S. agricultural equipment manufacturers benefit if farm goods get carved out of retaliatory tariffs. Companies with primarily domestic supply chains and customer bases, utilities, banks, real estate, are relatively insulated. Defense contractors often benefit during periods of international tension. But here's the thing. These winners don't offset the broader damage. The steel industry employs about 140,000 Americans. The retail industry employs 16 million. The auto industry supports 10 million jobs. When you help 140,000 at the expense of millions more, that's not good policy. It's special interest politics. All right, so you've heard the situation. Now you want to know, what does Warren Buffett do in an environment like this? How should you think about your investments? First, let me tell you what I don't do. I don't panic. I don't try to time the market based on tariff tweets. I don't sell everything and go to cash because policy is uncertain. That's a losing game. What I do is focus on fundamentals, look for quality, and remember that over the long run, American businesses always found a way to adapt and prosper. The fundamental principles rule number one: own businesses, not stocks. There's a difference. When you own shares of Coca-Cola, you own a piece of a business that sells drinks people want. Tariffs don't change that. The business might face higher costs for a while, but if it has pricing power and a strong brand, it adjusts. Companies with strong competitive advantages, what I call moats, can pass through costs to customers. Companies without moats get squeezed between rising costs and price-sensitive customers. In this environment, I favor companies with pricing power. They can raise prices without losing significant volume. Think consumer staples with strong brands: Procter & Gamble, Coca-Cola, Colgate. People aren't going to stop buying toothpaste because it costs 50 cents more. Domestic operations. Companies that manufacture and sell primarily in the U.S. are insulated from tariff impacts. Utilities, banks, insurance companies, real estate. Berkshire owns substantial stakes in these sectors for a reason. Capital-light business models. Software companies, payment processors, advertising businesses. These don't have physical supply chains that tariffs can disrupt. These and MasterCard don't care about Chinese tariffs. Strong balance sheets. Companies with lots of cash and little debt can weather disruption. They can wait out competitors who are more financially fragile. They can invest when others must retrench. The sectors to watch carefully, I'm cautious on. Retailers with heavy import dependence. If they can't pass through cost and they're buying primarily from high tariff countries, their margins get crushed. Some won't survive. Companies without pricing power in tariff categories: furniture, apparel, consumer electronics. If you're a marginal player in a category where customers shop primarily on price, you're in trouble. Highly leveraged companies. When uncertainty is high and revenues are pressured, debt becomes dangerous. Companies that were over-leveraged going into this mess are at risk of default. Companies fighting with Trump. Trump has shown he'll target specific companies with additional tariffs if their CEOs say things he doesn't like. Mattel faced 100% tariff threats after their CEO said they wouldn't move production to the U.S. Apple faced 25% iPhone tariff threats after Tim Cook mentioned India. This is Banana Republic stuff, but it's real. If you're invested in a company whose CEO is publicly fighting with the president, factor that risk in. The long-term view. Here's what I know from history. America's faced bigger challenges than this. We've had actual trade wars, real wars, depressions, financial crises, energy crises, and countless policy mistakes. The Smoot-Hawley tariff was a disaster, but American business adapted and the economy eventually recovered. The 1970s were a mess of inflation, energy shocks, and economic stagnation. But the companies that survived came out stronger. If these tariffs persist for years, supply chains will adjust. Companies will move production, automate more, innovate around constraints. It won't be cheap or easy, but it will happen. The stock market has recovered 26% from its April lows. Why? Because investors eventually realize that Trump's worst threats often don't materialize, and that American businesses are resilient. That said, I wouldn't count on Trump always chickening out. Some of these tariffs are here to stay. The baseline 10% on everything, the Section 232 tariffs on steel and aluminum, those aren't being negotiated away quickly. The cash position Berkshire Hathaway is sitting on over $300 billion in cash and short-term treasuries. People ask me why we're not putting it to work. Here's why. Uncertainty. When I can't predict with reasonable confidence what the policy environment will look like in 5 years, I'm comfortable waiting. Cash doesn't have exciting returns, but it also doesn't go to zero. And when opportunities arise, and they will, we'll be ready. In an uncertain environment, cash is optionality. It's patience. It's the ability to act decisively when others are forced to sell. I'm not saying you should be 50% cash. Most people can't afford to miss years of market gains. But having some dry powder, some cushion, some room to act if markets panic again, that's prudent. The bottom line. These tariffs represent the most significant change in U.S. trade policy in 80 years. They're disrupting supply chains, raising costs, creating uncertainty, and risking retaliation. The legal foundation is shaky, with the Supreme Court potentially striking them down. But even if the tariffs are reduced or partially removed, we've entered a new era. The era of steadily declining trade barriers and expanding globalization is over, at least for now. American companies will need to navigate a more protectionist, more uncertain, more politically volatile environment. That's challenging, but it's not insurmountable. Focus on quality businesses with strong fundamentals. Avoid over-leveraged companies in vulnerable sectors. Keep some cash for opportunities. And remember, over the long run, American business has always found a way. You know, when I was 11 years old, I bought my first stock, 3 shares of Citi's Service Preferred at $38 per share. Stock immediately dropped to 27, and I held on in terror until it recovered to 40, then sold. It eventually went to $200. That experience taught me 2 lessons. First, markets fluctuate, sometimes wildly. Second, if you sell every time things look scary, you'll never make real money. These tariffs are scary. The economic uncertainty is real. Some companies will suffer, some will fail. But America's greatest businesses, the ones with strong competitive positions, excellent management, and the ability to adapt, will navigate this just like they've navigated every other challenge. My advice is simple. Focus on what you can control. Invest in quality businesses you understand. Don't try to outsmart the market based on tariff headlines. Build in a margin of safety. Keep some cash reserves. And remember that over any 20-year period, American business has never failed to deliver positive returns to patient investors. These tariffs will eventually be resolved, reduced, modified, or struck down. What won't change is the fundamental truth that quality businesses create value over time. Stay calm, stay rational, and stay invested in America's future. Just be smart about which parts of that future you're betting on. Thank you for listening. Now, if you'll excuse me, I've got an annual report to read and a cherry Coke to enjoy.